Here's a summary of BHP's 2025 financial year earnings call, designed for clarity and readability. BHP FY 2025 earnings call summary. Good morning, everyone. Today, we're reviewing BHP's strong performance for the 2025 financial year. This year has again showcased BHP's resilience, strength, and operational excellence. CEO's key statements. Mike Henry. Our strategy remains clear and simple. We choose to be in highly attractive commodities with resilient demand and steep cost curves. We own world-class assets that are large, long life, low cost, and with options to grow. We operate them excellently, generating maximum possible shareholder value for the capital deployed, and we bring a differentiated approach and focus to creating social value with those around us. Our results continue to prove the value of this strategy. Mike highlighted that BHP has refined project sequencing, which is expected to deliver average production growth of 2.2% per annum over the next decade. This refinement has also led to a reduction in capital spend by $1 billion per year over the medium term, and a revised net debt target range of $10 billion to $20 billion, reflecting the significant improvement in the business and portfolio. He emphasized that China and India continue to demonstrate resilient economic and commodity demand growth, with India projected to be the fastest-growing major economy. Mike also noted the increasing global focus on critical mineral supply and supply chain security, positioning BHP well for the future. He celebrated BHP's 140-year journey and its deliberate choices in reshaping its portfolio to anticipate global megatrends like population growth, urbanization, digitalization, and the energy transition. The choices we've made set us apart from our competitors and have strengthened our position. Our commodities have large markets, resilient demand, and steep cost curves. The world is going to need a lot more steelmaking materials, a lot more copper, and a lot more potash. CFO's key statements. Vandita Pant. We have again delivered a strong set of results. Our underlying EBITDA margin remained very healthy at 53%, continuing our track record of achieving an average margin exceeding 50% over the past 20 years. Our return on capital employed was 21%. Vandita elaborated on the financial performance, noting that the 10% decline in EBITDA was entirely due to commodity prices, while favorable foreign exchange was offset by inflationary pressures. Despite these headwinds, unit costs at major assets improved almost 5% year-on-year. She pointed to specific divisional successes. Western Australia Iron Ore, WAIO, achieved record production and shipments, maintaining its position as the world's lowest-cost major iron ore producer for 6 consecutive years, with a 63% EBITDA margin. BMA Coal, volumes were up 5% despite weather disruptions, with progress in supply chain stabilization. Copper generated a record $12 billion in EBITDA, representing 45% of the group total, with an impressive 59% margin. Escondida saw a 16% volume increase, its highest in 17 years, at an improved cost. Spence also achieved record production. Vandita detailed the capital allocation framework, emphasizing discipline and a commitment to shareholder returns and value-driven growth. She highlighted a continued focus on capital productivity, optimizing project sequencing for enhanced value and deliverability, and improving capital efficiency. The pace of decarbonization technology development has slowed, with expected spend now in the 2030s, though 2030 greenhouse gas emission targets remain on track. Overall, we now expect capital and exploration spend to be around $11 billion in both FY26 and 27, and to average $10 billion per year over the medium term, around $1 billion per year lower than previous guidance. We remain flexible to adjust our capital expenditure and phasing to accommodate market dynamics and cash flow generation. She also explained the revision of the net debt target range to $10 billion to to $20 billion, stating, "Over the last 3 years, since we last changed our net debt target range, our underlying business and portfolio has improved significantly. In short, BHP is a stronger, more resilient company. And in line with the enhanced debt servicing capacity this brings, we have revised our net debt target range to $10 billion to $20 billion. Key financial metrics and highlights: revenue, not explicitly stated as a single figure, but implied by strong EBITDA and EBITDA margins. Profit, underlying EBITDA margin remained strong at 53%. Return on capital employed was 21%. Gross margin, underlying EBITDA margin of 53%. WAIO EBITDA margin of 63%. Copper EBITDA margin of 59%. Dividends. A final dividend of 60 cents per share was declared, bringing the full-year dividend to $5.6 billion. Production. Record iron ore and copper production, with copper volumes growing 28% over the past 3 years. Copper equivalent volume growth was up around 4%. Capital spend. Revised medium-term capital and exploration spend to average $10 billion per year, a reduction of approximately $1 billion per year from previous guidance. FY26 and 27 spend expected around $11 billion. Net debt. Revised target net debt range to $10 billion to $20 billion. Social value contribution. Almost $47 billion contributed globally through wages, taxes, royalties, community contributions, and supplier payments. Gender balance. Achieved gender balance in the global workforce, with female representation at 41.3%. Safety. Year-on-year improvements in key safety metrics, with no fatalities on the job. Significant reduction in high-potential injury frequency. Management forecasts for future quarters/years. Production growth. Average production growth of 2.2% per annum over the next decade, assuming projects proceed. Capital spend. Average of $10 billion per year over the medium term. FY26 FY27 around $11 billion. Net debt. Target range of $10 billion to $20 billion. WAIO growth. Firm plans to grow production to 305 million tons per year by the end of FY 2028, with potential growth up to 330 million tons. Unit costs expected to improve to below $17.50 per ton in the medium term. Copper South Australia. Aspiration to double copper production remains unchanged, with Phase 1 of smelter and refinery expansion FID expected in FY 2028. Vicuña Project. Integrated technical report expected by March next year to inform future development. Significant risk factors. Commodity prices. The 10% decline in EBITDA was attributed solely to commodity prices, indicating ongoing price volatility as a key risk. Inflationary pressures. While unit costs improved, inflationary pressures remain a factor that offsets benefits from favorable foreign exchange. Policy uncertainty. Global economic environments continue to navigate policy uncertainty, which influences investment and trade flows. Project execution. The Jansen Stage 1 project experienced higher inflation, cost escalation, and lower productivity, leading to revised cost and schedule estimates and a deferred timeline for Stage 2. This highlights execution risks in major projects. Decarbonization technology. The pace of development for certain decarbonization technologies, particularly diesel displacement, has slowed, delaying anticipated spend to the 2030s. Fiscal policy and regulatory settings. Stability and certainty in fiscal policy and regulatory settings are required for expanded operations, particularly in Copper South Australia. Water supply. Expansion in Copper South Australia is dependent on securing a sustainable and secure water supply, necessitating the progress of the Northern Water Project. Highlights. resilience, and operational excellence demonstrated across the business, leading to strong financial and operational results. Record production achieved record iron ore and copper production. Sector-leading margins maintained very healthy EBITDA margins, averaging over 50% for 2 decades. World-class assets, strong portfolio of large, long-life, low-cost assets in attractive commodities. Cost leadership. WAIO remains the lowest-cost major iron ore producer globally for 6 years. Strong cash flow generation, underpinned by operational performance and disciplined capital allocation. Shareholder returns. Commitment to shareholder returns through dividends, with a 60% payout ratio for the final dividend. Social value creation. Significant global contribution beyond direct financial returns. Gender balance achievement, a major milestone in workforce representation. Safety performance. Continued improvements in safety metrics with 0 fatalities. Lowlights. Jansen Stage 1 cost and schedule revisions. Disappointment expressed regarding cost escalation and productivity issues at the Jansen Stage 1 potash project, leading to revised estimates and a deferred timeline for Stage 2. Decarbonization technology pace. Slower than anticipated development of certain decarbonization technologies impacting future spend timelines. In conclusion, BHP has delivered a strong 2025 financial year, marked by operational excellence and resilient financial performance. While facing some project-specific challenges and external headwinds, the company remains focused on its core strategy of investing in attractive commodities with world-class assets, optimizing its capital allocation, and delivering value for shareholders and stakeholders alike.